In this video, we're going to have a look at SAP, the biggest German company, a German multinational software company based in Walldorf. SAP develops enterprise software to businesses and is the world's leading enterprise resource planner software vendor. Now, in all fairness, I have only heard minimally of this company, but they are the biggest in Germany, and for that reason I wanted to have a look at exactly what it is they do, how their financials have been for the past 10 years, and whether or not we think that SAP is a good stock to buy right now and hold for a decade. Let's dive right into their financials. So looking at their revenue here, what we can see is they started with 16 billion in 2012, which has risen all the way to 28 billion in 2021, which is a nice and steady growth. We can see here a revenue growth of 5.5%, as of course the IT business is more and more essential in the modern world. Looking at their EBITDA, their earnings before interest, taxes, depreciation and amortization. Now, because they are a software company, there's not that much depreciation or amortization to speak of anyway, but I always want to look at EBITDA to see the flat bottom line earnings and see whether or not that is increasing. And we see here that their earnings was 5.5 billion in 2012, which has risen all the way to 6.5 billion here in 2021. Now we do note here that their earnings are lower in 2021 than they were in 2020, even though their revenue was higher. And this is presumably because of some additional costs during the COVID times, or maybe some additional costs during the inflation period. But nevertheless, their earnings in 2021 are down compared to 2020. Overall, we see an EBITDA growth of 1.6%, which is a lot lower than their earnings is, which kind of means to me that their margins, their profit margins are decreasing every single year. Now, of course, it is very well possible 2021 was a bit of a fluke, and the moment that we actually insert a number like 8.5 billion here in 2021, we do see a trend line more in line with their revenue, but we still see the discrepancy between revenue and earnings, which is to say we see earnings growing less fast than revenue, which still means that their margins are decreasing. So this is not a nice thing to see, but let's move on from here. Looking at that debt level, we can see that overall they've never really had that much debt. Here in 2012 they were leveraged at below 1 times compared to EBITDA, which is amazing for any investor who wants a safe place to put their money. Now, of course, the debt level has been increasing for the past 10 years, and in 2021 they reached 13 billion, an increase of 10.5% annually. But of course, they also have quite some cash on hand, so if they want to, here in 2021, they can reduce that debt level to below the 1 times ratio. So even though this number has come up quite a bit, they also have quite some cash in the vault, which they can use to remedy that, which gives you a very nice cushion still as an investor, knowing that this business, even though it has some leverage in the form of debt, they can easily pay that off with the cash that they have on their balance sheet. Market cap has been increasing by 7.7%. Now the market cap is really just the amount of shares outstanding times the average share price. And we can see here that for the last 10 years the share price has increased by 7.7% every single year. This then brings us to enterprise value, which is the entire value of the business. The moment that we take our market cap and we add the debt and subtract the cash, we can get the enterprise value. And what we can see here with the overall percentage growth every single year is that enterprise value is quite in line with market cap, which is quite in line with what we've seen before, because even though their debt is growing, so is the cash power that they have to remedy that, so the entire enterprise value is mostly consistent of that increase in market cap. EV/EBITDA ratio, what is the multiple that people assign to SAP? Now, of course, because it is the biggest company in Germany and it has to compete with quite some big brands like the automotive industry of Mercedez Benz or Volkswagen, even compared to those companies, SAP is by far the largest one, so of course a company like that trades for a premium. Add to this that SAP is a software company which is known for having pretty nice margins and known to have very minimal capital expenditures. I can understand why the multiple is relatively high. I do think that 26 times as seen here in 2019 was a bit excessive, even though they are the biggest company, because we also see that their earnings haven't been growing that much, and I think for that reason I think a multiple of 26 times is really excessive. But I do think 17 times is probably quite accurate for a company like this that has a lot of security and minimal downside risk. Looking at their net debt to EBITDA ratio, we can see, just like we saw with their debt and excess cash level, that they are very unleveraged. They do see 1.4 times here because they didn't have as much cash on hand, but most of the time, even though their debt level is coming up, so is their cash level. So their overall net debt level is not increasing, it's actually remaining quite stable while their earnings is growing. So very nice net debt to EBITDA ratio here, well below the 3 times mark that we usually want to see when we are looking at a safe business. So this then brings us to cash flow. Cash flow from operations has been increasing by 5% every single year, which is very nice to see. 3.8 billion in 2012, 6.2 billion in 2021. Capital expenditure has also been going up, but at a slower pace than their cash flow, which does indicate that when it comes to their cash flow margins, we do see an increase here. This then brings us to free cash flow, which is the cash flow from operations minus the capital expenditure. Because their cash flow from operations has been growing in line with their capital expenditure, that the free cash flow growth is also in line with this number, so 5% every single year. Share count is not much to say here. The share count has been remaining relatively stable for the past 10 years. They are not buying back shares. They do issue a dividend, but they are not buying back shares. Free cash flow per share has also been going up steadily by 5% in line with the free cash flow itself. And of course, because shares are not decreasing, free cash flow per share is increasing in line with free cash flow itself. So this brings me to the price per share as seen on the stock market. We can see here in 2012 they had a price per share of 16 euros and 69 cents, which has risen all the way to 123 euros and 36 cents, an increase of 7% every single year on the stock market itself. Now of course this number does not include the dividend that they are paying, because of course the dividends are retracted from this number, so the overall IRR is probably higher than this, but just the return on the stock market is 7%. They have a free cash flow yield of about 4%, which I think is in line with the multiple that we've seen. It's quite on the low end when it comes to valuation, but this is because SAP is trading at a premium. For being so established, for being so big, and for being so unleveraged. So this then brings us into the business of trying to forecast SAP into the future. What we have seen with their earnings is that they've been growing very slowly by 1.6% every single year. Even though 2021 may be a low year for them, because they definitely had higher numbers prior to this with a lower revenue, I do actually expect this number to be higher, but I'm going to take this number anyway to give myself a conservative estimate. And if my conservative estimate beats the stock market, that's when I'm going to be interested. So I'm going to expand their earnings by 1.5% for the first 5 years, as they've been doing historically for the past 10 years. After that, I'm going to reduce that earnings growth to 1% because I'm not sure what the future holds, but they are already the biggest company in Germany, and I think the amount of market share that they can win in the future is probably quite limited. So for this reason, I'm giving them an EBITDA growth of 1%. I'm going to attach the multiple of 17 times because I think these multiples here for the past few years have been a bit excessive, and I think 17 is probably in the nicer range. I think 11 to 13 is a bit too low, so I'm just going to be right in the middle of that. I'm going to say 17 times, which I think is a fair and accurate valuation of their future multiple. This gives me an enterprise value 10 years from now of 125 billion. Subtract the debt, add the cash, gives me a market cap of 120 billion, divide by the amount of shares outstanding, gives me a stock price 10 years from now of 100 euros. And we're going to do the same thing for free cash flow. Historically, they've been growing it by 5% every single year. I'm going to reduce this to 4% and project that for the next 5 years. I'm going to say they're growing their free cash flow by 4% for the first 5 years and then 3% for the 5 years after that. Because like I mentioned, I'm not sure what's going to happen, but I can imagine that the amount of market share they can capture is limited, so I'm going to reduce this number just to be conservative. I'm going to give them the free cash flow yield of 4%, which is quite in line with what they've been doing historically, while still being on the conservative end of that. This gives me a stock price 10 years from now of €155.59. Now, if I take both my valuations of enterprise value as well as free cash flow, I get an overall share price 10 years from now of €127.01. Right now on the open market, I can buy as many shares as I want for €108.50. This gives me a compounding annual growth rate, an increase in share price as seen on the stock market itself and only on the stock market itself of 1.6%. But of course, like we mentioned, SAP is very much a cash flow positive machine. They produce a lot of free cash flow, and free cash flow is your pro rata ownership of the company. The moment that you buy a company, that company then operates, does its business, and all the money that's left in the vault at the end of their operating year is basically what you've earned as the investor. Now the company can choose to use this money to either buy back shares, issue a dividend, expand their operations, or buy down their debt. Now, they don't have any debt to buy back. They are not doing share buybacks, although I do think with their current free cash flow, it could be a nice idea to really reward the shareholders. They do issue a dividend, and they also use this money to expand their operations. So, of course, if we include this money, we get an IRR of 7.1%. I always say on average the stock market returns about 10% every single year. So when looking at that number, I think SAP is going to underperform the market in the next 10 years. But let's see what happens if the share price comes down or goes up. Let's see if I'm interested if the share price comes down at, let's say, 10% to €100, then I expect an IRR of 8.7%, which is still not that attractive to me. The moment that the share price comes down by 30% to an IRR of about 12.2%, I think at that moment I will be quite interested in this company, because I've given them a conservative estimate, because I took an EBITDA number for them of 2021, which was arguably a low year for them. Now, the moment that we, instead of taking 2021, we take the year 2000 and we project it from there, we can expect a share price of 125 for this forecast and a compounding annual growth rate of 2.6%, leading to an IRR of 8%. And of course, that will already increase my IRR here. Now, of course, you do have to realize that SAP is a very big and mature company, and the risk of bankruptcy is very, very, very limited. So I think SAP is a very safe investment, and because there is not really a big risk, there's also not really a big reward. So this was SAP. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!